back to the Pulver Report. It is 9 o'clock on June 10th. Let's kick things off with a little catch up. It's been a week. I was out of town. Nice to be back and looking forward to trading this week. We have some expected volatility with the comp on Wednesday. We have CPI data for the U.S. as well as FOMC with a rate decision and a press conference from Jerome Powell. So most of this week's volatility, in my opinion, is going to be revolving around that. For Wednesday, directionally, as far as where the major indexes go, the ETFs go, that's what I'll be watching. If we have a very calm couple of days, i.e. today, tomorrow, leading into mostly volatility on Wednesday, that's going to help me position for probably this Friday or next Friday, maybe even out a little bit further just to see how things price out and see where volatility sits. A couple other things just for some housekeeping. We have a big conference going on with Apple this week, talking about their new phone, generative AI, like Siri 5.0 or something like that. Also, the stock split officially hit for NVIDIA today, where their price is starting around 120 bucks. I want to talk about the technicals there because I think we're in a pretty good setup for a correction in NVIDIA. Hopefully offering up something around $100 or less as far as a chance to buy a dip. NVIDIA, of course, can do no wrong. They are currently sitting between Microsoft and Apple as the world's largest company, number 2, with a $3 trillion market cap. The market's pushing towards all-time highs. We're up 12+% for the year in the S&P, 16+% for the NASDAQ. And here we are around the halfway point of the year. Big Fed meeting this week on Wednesday. Will we see the Fed spoil the party? Will the Fed continue to allow the market to fuel this rally and continue to run? I think we're running pretty hot. I think technically we're due for some corrections. I could see the markets being talked down a little bit this week by the Fed, trying to push back on, if we're cutting, when we're cutting, how many cuts, and we'll see how the market interprets that price action wise. So that's all going to be important this week. So that's it for little pre-market assessment. Let's jump into the charts. Good morning, David. Good morning, Ruth Ann. Good morning, Keith. Good morning, Joe. Nice to see everybody. Good morning. Good morning. Morning, Willard. And it is certainly nice to be back. Surprisingly, for going across the globe, I was in Germany for the last week. Surprisingly, came back without really a massive time zone hangover. Part of it might have been because the flight back was 8.5 hours plus another 4.5 hours, and I tried to sleep most of that. And then we got back, I think it was late Saturday night here in Utah and Salt Lake City, and then just had a solid sleep through Sunday. So I don't know, it might catch up with me this week, maybe it doesn't, but I'm here and things seem to be operating 100%, so I'll stick with that for right now. Maybe I'm just excited to be back too. So it was obviously a little weird. I don't take breaks from the market that often, and I thought last week ended up being a good week to take a break. I was monitoring things on my end. P&L was high. Had some trades close out by Friday that were full profit, so I really didn't have to do a lot of maintenance. This week I'm going to be more short-term positioning, so we'll talk about that today in this session. I'll jump on with A1 Trading, I believe, at the top of the hour at 10 a.m. See if I can jump on with Frank. We'll kick around some ideas, but I'll be looking at some ETF trades this week, something in the short term, the next 1 to 2 weeks out, and then also looking to manage some positions, trying to get repositioned for some of these possible pullbacks that I see happening in the next couple of trading weeks. So let's see. Sharon, good morning. Nice to have you here as well. And okay, so SPY sitting at 533.06 pre-market, down about $1. Qs pre-market down about $1. DIA, the diamonds, down about 50 cents. So couple things that I'm watching this week. I do have some exposure on all of these. So I have ratio spreads on the diamonds, ratio spreads on the Qs, ratio spreads on the SPY. I have ratio spreads on some of the Mag 7. I believe I have it in Google, Apple, and some others. That's a ratio spread right there in Apple. I have ratio spreads and naked puts on Amazon. Google already expired, so I'm going to look at some fresh trades on Google. Microsoft is a little bit pricier, so I'm not looking at ratio spreads, but I could look at some wide iron condors or maybe just a wide credit spread. And again, I want to base this on the implied volatility. I mean, if I see stocks that are over 30 to 40, I'm more inclined to sell options. If I see it probably less than 20, obviously less than 30, but less than 20, more inclined to look to buy options. So this week, starting things out, we're about to see, let's see here, 12.6 on the SPY is the implied volatility rank. That's still pretty light. I've seen this as low as 2 to 3 in the last couple of weeks, and I've seen it as high as 40 back in April when we had a correction. So I do expect price to jump a little bit. One instrument that we should all be watching and pay attention to would be your VIX. We're at 1320. Recently, we had some spikes up to 15. I do have some chart alarms at 16 plus and $20 just in case we see a short-term decline. Let's talk about NVIDIA. Price you can see here is at 120.89 with the adjustment for the 10-to-1 split. And we have a 119.45 pre-market, which is down about $1 and change. Implied volatility rank on NVIDIA is in the 40s, I believe, 41.3. I wanted to talk about this one technically because I think that after this run, wave 1, 2, 3, 4, and 5, again, stock markets don't necessarily have to behave as rationally and as technically as other instruments like Forex, for example. When stocks have this positive drift and they're supposed to go higher with stronger companies. And, right now we're in this extremely high concentration stock market, right? Most of your gains this year have been produced by a handful of companies. If it wasn't for Microsoft, if it wasn't for Apple, if it wasn't for NVIDIA, if it wasn't for Google, if it wasn't for Meta, if it wasn't for Netflix, if it wasn't for the household names that become these storied stocks in this large cap tech or everything that's really been growing the last 10 years, the stock market would be a fraction of what it is, right? The S&P is up around 12%, the Nasdaq's up around 16%. Most of those gains, a high percentage of those gains have been because of few stocks. Again, does that change? Does that mean that we're too concentrated? Not at all. It means that if those stocks continue to do well, they are large enough that they're going to drift and drag this market higher. So would it be nice to see that NVIDIA can just have a check, like a reality check, and we can have a bit of a dip? I mean, I like the idea of, exposure wise for me, if I have a $100,000 account, I wouldn't mind having 3% exposure, 5% exposure on NVIDIA longer term. I listened to an interesting podcast this weekend that talked about there's a difference between a moat and a head start. And right now, NVIDIA has an incredible head start compared to other companies. But when you think about the sheer power and force and determination of an Apple or a Google or a Microsoft, they don't necessarily have to be first to market, but they can still come into the AI space in their own way with their tools and resources and their power and do it how they want, and probably pretty good at it. I would venture to say that if anybody is out there doubting that Apple can't get their head around the AI space, you're probably wrong. I mean, anything that they've really done, they've been top dog at, essentially. So Apple is a moat, right? Google is a moat. NVIDIA, in 5 years or less, but I would say certainly in 3 to 5 years, NVIDIA that has this head start now is going to be facing a wave of competition when other companies, like the ones I just mentioned, make their own chips and make their own chips as cheap or make their own chips with similar margins that NVIDIA has right now. But that doesn't mean that NVIDIA is a terrible stock. I just think that I wouldn't mind having the exposure. A 10-for-1 split offers a very affordable buying opportunity, but it's going to be met with probably some decent volatility. So do I just instantly want to jump in and buy the stock? No, I'm looking at this from a technical standpoint. If we have a pullback, and again, remember this market cap, $2.97 trillion is not chump change market cap. If NVIDIA pulls back into this gap, for example, this is strong enough and big enough to drag the entire Qs down with it, to drag the SPY down with it. It will matter a lot. Okay. So from a technical standpoint, typically a wave 5 finish gets us back to a wave 4 correction area. So if we have 1, 2, 3, 4, 5, we usually see an ABC correction that gets us back somewhere between the test of this resistance or the challenging low of this wave 4 move. And if this is wave 4, we'd be looking at somewhere between, $100 to $80. And I don't know where that bottom is, but I would be willing to position my trades in that area. So things I would look at, I can do some wide credit spreads and be willing to take ownership cheaper. I can do ratio spreads, put a little bit more buying power, but know that I'm looking at getting a decent credit for that. but I don't, obviously it's a lot different than trading a $1,200 stock. So, I'm more interested now with that exposure. So what I'm kind of hoping is that we have some, some late to the party buyers that just see that, the split has happened. It's ran up all the way through to that split and having positive earnings all the way. A little bit of cashing in would be kind of nice. A little bit of a technical correction, a little bit of, maybe it's the Fed this week. Maybe the Fed has to talk things down and we see a bit of a correction happening. I still go back to my bigger picture trades on the SPY. The diamonds actually have already responded to a bit of a correction, but the Qs, we're sitting here, we poked again all-time highs. I think the SPY marked 24 all-time highs for the year, which is an impressive run. I think right now that's about what I read on that. It's like 12th all-time for one of the best starts for the first half of the year. We're nudging up, 24 all-time highs. I mean, I don't know what year marked like the most all-time highs, but I want to say of 220 to 230 trading days for the year. We've seen some instances like a 2017 or 2019 when the market could do no wrong. We started to see like 70, 80, 90 new highs for the year. Over a third of your trading days were just new highs, without a lot of dips, right? So anyway, a lot of good things to still take away from the market. Portfolios are up, 401ks are up, retirement accounts are up. Really, people can't really do much wrong. There's drama out there, of course. I mean, Roaring Kitty's been in the news the last couple of weeks. GameStop's been all over the place. If you feel like gambling, then trade GameStop. If you feel like gambling, go to the casino. That's not what trading is. It's funny because that's not what I've ever felt like I do. I mean, trading is not gambling. It's calculated risk. You're trying to put probabilities to everything that we do. And I wouldn't know, what would I want to do with this? Nothing. I mean, how do you trade this outside of you're trying to get lucky? This is a trade and pray type approach, and I think that is it's not worth it. So I think it's headline worthy. It is what it is. This is the meme stock craze and FOMO and whatever else. But in the background, we just see stocks plugging away, markets grinding towards all-time highs. And here's where the rubber meets the road. So let's go year to date. Okay, S&P's up over 12% for the year. We have seen a bit of a shift. I was noting this not too long ago that, energy up double digits. Now it's cut back to about 7.34. Utilities, actually one of the best performing sectors this year, has peeled back a little bit to 10.44. So now, who is leading the charge? We still have financials hanging in there at 10.32. That would be big finance, big investment banks, as opposed to your regional banks. We're still dealing with all that, cusp of high duration stuck in the balance sheet, liquidity problems. But as we saw with Signature Valley and I think First Republic Silicon Valley and Signature Bank and First Republic and a couple of other ones, the Fed was there to kind of step in and backstop, as well as other central banks. Those are the resources and really policies put into place through 2008's financial crisis. So not saying it's the right approach, but it certainly is better than insolvency and all of a sudden a run on banks. Nobody wants that. Right. There's bigger problems ahead if that's what we're dealing with. So financials hanging in there at 10.32. It's nice to see double digits there. A little bit of diversification, but most of the gains for the S&P are led with communication services, which we know incorporate Mag 7, as well as technology. That's it. Most of the gains are there. Now, on a positive note, consumer discretionary scaling back a little bit, red on the year, and real estate, we're one of the least affordable. We're in the least affordable housing market of all time. Wages are up, but they're not outpacing inflation necessarily, or they have been the last 3, 4, 5 months. But if that starts to flip and go inverted, where all of a sudden wages are not keeping pace with inflation, that's a problem. Unemployment, we've talked about the softening labor market, the last couple of job prints with non-farm payroll. This last print came in higher. Revision was slightly lower, but we saw an uptick to the unemployment rate, now up to 4%. So, job numbers are we're seeing some job losses out there. This is what AI started a couple of years ago. In truth, COVID started it. AI is accelerating it. And this is where some of the big tech companies have fattened up their profit margins. Corporate profits have printed actually a little bit higher. And a lot of that's due to being able to cut jobs in the last year. When 2022 happened, that was a big deleveraging in a lot of companies. And then they came back and resurfaced in 2023 looking at better financials. So all these things, I mean, whether you realize it or not, COVID to AI to now is why we see companies in the stronger positions that they're in. They've scaled back, they've cut, they're doing more with less. AI is a big contributor to that. And now it's the buzzword that can do no wrong. And you look at something like, a company like Nvidia that has just it literally can't miss. But like I said, now that we've had the 10-for-1 split, I personally would like to see a chance to, buy a dip, position for it. So I'll talk about that more in the trading rooms and how I want to start playing that. But this is where we're at for the sectors. Ron, good morning. Nice to see you. Let's go to let's go to this week. All right, so we're about 15 minutes away from opening bell. 533.20 is pre-market. The SPY is still averaging around $12 for the week. And the first thing I'm going to look at for the SPY is to kick things off. We're at an IV rank of 12.7. If I just go into my positions and trading here. So going into, this week's trading, right? If I just bought, let's go to a Friday the 14th. If I just looked at this week's expiration and I bought let's go at the money. So we're trading around 533 and change. I'd probably do like a 534 call and a 533 or something like this where I split the difference and I go one strike out. Right now I can see here that this difference would be about a 644 debit. Now, I'm not selling anything against this yet, okay? So if I want to tighten this up, I'm probably going to pay roughly the expected move. So we're seeing expected move here around 7. This is a little bit softer than what I see on a week-to-week high to low. So, I mean, the average trading range is still around $12. The tough part with a week like this is we could have volatility going both ways. So we could get a $6 or $7 move up and a $10 move down, and then your high to low stretches around $9 or $10, but it only went up, let's say $5 or $6 and then down 10. You're really only getting a $4 to $5 stretch above or below price, which means that if you're long on those options, it's a losing position. So I'm a little cautious going just to this Friday, especially if we have. I think if I waited until Wednesday morning, that might help me a little bit position for this. But I'm probably going to end up paying close to the same. I think there is enough implied volatility that will stay in the market this week. That if I did like a 2-day expiration on Wednesday, and I wanted to buy something near the money, at the money, or I did a weekly trade, or next week, if I went out to next week, which would be the 21st. Let me delete these here. If I went out to the 21st, give me a couple more weeks, or at least I'm sorry, another week of trading. I'm going to be paying a lot more for that time. Okay, but how much more do I pay? I'd pay about $2 and $2.50. Now I'm paying for time only, right? So I can make that cheaper by stretching these out. That shaves down about $1. Is that what I notice here? Yeah, I think so. So if I go out one strike, that takes about $1 off the trade. Now I could give myself some upward, let's say I go to like the 5, let's see, that'd be 35, 45. I could probably stretch this up to like 12 or 13 and just sell the expected move. So do 48 if I sell the call there. And then the 33 down to the 20, sell something there. Now what's crazy is I'm looking at about a $13 difference between the calls, and I'm only collecting about 36 to 37 cents on that call. Now, again, this is going to adjust here in the next 12 minutes when we go to live price. But what's interesting is if I go up $13 from buying a call to selling that call and creating a debit spread, I'm only getting about 36 to 37 cents on that sell option, right? If I sell the 538 to make it a debit spread. If I do the same thing where I buy a 533 put, okay, and then I go $13 against that, look at how much more I collect on the put side. A lot more. I mean, the put skew here is ridiculous. It is favoring way more premium on the put side, which tells me a couple of things. One is that the market is leaning heavily towards a jump in volatility to see these puts, number one, collecting more, like volatility can jump. And number two, I mean, part of me wants to get this further out of the way and see if I can turn this into a bigger win. I mean, right now, I look at about a $710 max loss for about a $600 max win. But if I increase this to the downside, let's say that I go from 533, let's say I go to 518. Well, I pay a little bit more, so 710 right here. 731. I pay about 20 cents more, but give myself another $2 of profit. Now all of a sudden, my risk is about the same, $7.30, for my reward to be slightly bigger than that if I'm right on the bearish side. So anyway, I'll talk about that more when we see some live prices here in about 10 minutes or so. But this is probably what I'm looking to do is, kind of embrace this week's volatility. We have non-farm last week. The market as a whole, I mean, like I said, I was away last week, but I was watching price pretty closely. This was a pretty typical move for a given week. We had a green candle on the week, and mainly that was because that wild Friday we had on the 24th of May, or sorry, the 31st of May. We had that big sell-off where we started up around 525, went all the way down to 518. That was a big $7 move, and then the market proceeded before close to go up like $8 to $9 from the low. That was a crazy swing for Friday to end the month of May. So we kick off the first week of June. We had non-farm payroll. This is Friday's action. Not really a lot happened. We had a bit of a correction on Monday to kind of rebalance that crazy wild move from Friday, and then we put in a low. We didn't take out last week's low, but we did take out last week's high, which probability is if we take out a high, we tend to stay green for the week. If we take out a low, we tend to stay red for the week. If we look at these opening bell ranges, we broke lower, stayed lower. We broke higher, stayed higher. We broke higher, stayed higher. We broke lower, stayed lower, broke higher, stayed higher. I mean, the good thing is market has tendencies, right? It has patterns, it has probabilities. And so this week's trading, this is what I'm looking for, okay? If we have the high for this week and we have the low for this week, I could see Monday's trading, so today, I could see Tuesday's trading, tomorrow, not really testing or closing above last week's high. I could see, and if that's the case, Wednesday I could see, Wednesday I would just say this: buckle up, because Wednesday would be the type of day that we could go up a couple dollars and false breakout to the highs and then close lower. Thursday has some follow through. Friday, end of the week, and we'll see where everything sits. But I wouldn't be surprised if Wednesday, Thursday, Friday are where most of the moves are going to happen, just because there's not a rate cut expected. Everyone's going to be watching to see what Powell says, and I mean the rate probability right now is still, if I go to that FedWatch tool, the FedWatch tool, we're still expecting to see zero cut this week. Going into July, still a pause. High probability that it's already just a pause through the entire summer. There is no FOMC in August. We'll just have meeting minutes. But then September, this is now about 50-50. So the market is still debating, what month is it going to be? Is it going to be September? Is it going to be November? Is it going to be December? Right? I mean, right now, September is a 50-50. Will they cut? Will they not? If they cut in September, I don't see them cutting again in November. I could see a September cut, see how it affects the market. Maybe it's high volatility, maybe it's not. Maybe the market runs with this and prices it in, or it's already been priced in for that matter. But I mean, this is just my personal opinion here. I think it's incredibly disruptive to have a rate cut on the 7th of November, 2 days after a very dramatic election. We know that whatever happens from November 5th election, whoever wins, whatever party wins, it's going to be 50% of people are happy, 50% of people might be pissed and upset. And it's a no-win situation. Like it's not going to be some unified, like everyone's happy now. It's going to be a shit show, for better, lack of a better word. But it's going to happen regardless. And so I just think it'd be really, really disruptive if the Fed steps in on that same week and says, we're going to do this on top of all the election drama. They can do whatever they want, because they could stand behind their, we're a independent power and blah, blah, blah. We have no allegiance and political alliance. Maybe that's true. Maybe it's not. But my point is, if the Fed's going to take any action, September, December would be the time to do it. One thing that they're now fighting, I mean, they've seen jobs get softer. They've seen wages stay relatively high. Housing is borderline unaffordable for a lot of people without overstretching. You're now, for your average home, it's now going to take about 30 to 40% of your gross income to afford that home. The difference between a 3% rate or 3.5% rate to now 7%, I mean, you're doubling. That is a 100% higher cost to you as a home buyer now, on top of buying furniture, buying appliances, putting in sod sprinklers, landscaping, getting your home livable. All these things factor into it's very expensive to buy a home, maintain a home, make it a home. Um, and I do think that the consumer has been stretched. So we might see that affordability continue. If you've been paying attention the last couple weeks, there's bills being kicked around about offering some type of home buyer credit for 10 grand, 25 grand. All that means is homes are going to become $10,000 to $25,000 more expensive. That's really what it is. That's no different than saying we're going to give every student's going to get a $10,000 Pell Grant. Okay, well that just made tuition go up $10,000. I mean, it sounds good and it might have the right intentions, but it's not going to price out that way. So still, until interest rates really go down, and that might be the positive to come from an interest rate cut, would be more of the peripheral stuff, not just the stock market, not just where we're at with rates, and it's really the outside, the refinancing, the movement in supply and demand. We've had so little supply out there. House prices keep going up. Inventory is super, super low. House prices keep going up, but home sales keep going down. So is it an easy market? Not really. I mean, I think people, if we see rate cuts and it's all of a sudden 25 basis points or 50 basis points, I think there's a little bit more motivation to either refinance. If you finance at 7.5% to 8%, you're probably thrilled to get something sub 7 or closer to 6.5%, 6%. But we might not see a significant refinance wave until next year. Think about this. Let's go to September. Okay, let's go to September next year, all the way out to 2025. So let's put our future caps on here and say a couple of things that lead more to this discussion. If we go all the way out to September 2025, we're looking at the official rate for the Fed to be around 4 to 4.25. Okay, that's only 1 to 1.25% different than we are right now. So this cut cycle is still pretty slow and very methodical. And again, I mean, in a good way, this is typically what we see cut cycles look like. It's not what we saw, post-COVID, where we go, or COVID to post-COVID, where we go immediately to zero and then within 14 months up 5%. That never happens. I mean, we were raising by 75 to 100 basis points. That was insane. 50 to 75 to 100 basis points. Those were crazy aggressive. And then the market's still kind of, digesting that, I don't know, that giant hoagie that was stuffed in its face with with rates. But now we're finally hitting that pause and that higher for longer. And is it appropriate to cut? And if so, how fast? Well, doesn't look like it's going to be that fast. If we get a tester cut in 2024, maybe that's 25 basis points. We'll see how the market digests it, right? If it doesn't have a spasm or throw a temper tantrum, then maybe they can cut again, a quarter later. And we can go quarter by quarter by quarter, maybe 25 basis points, and then see where inflation is at, see where the data comes in. You have to remember, yes, we have CPI data this week on Wednesday. This is what everyone's going to be paying attention to. Okay, so the combination of things for this week, we have US CPI, which is expected year over year to be 3.4. Previous print was 3.4. Okay, so it doesn't mean it's going lower. Fed keeps talking about being sub 2%, and this is also coming before the Fed in the afternoon. So if we see, let's say, and I don't know what, I mean, the forecast is 3.4. I don't know what's good or bad. Obviously, you'd think that a 3.3 or 3.2 would be good. A 3.4, 3.5, 3.6 would be a bit sticky. How does that affect, is there a game time decision for the Fed on Wednesday? Probably not. They're probably going to just not do anything. If the inflation prints higher, they'll probably acknowledge that and say, this is why we keep talking about 2%. It's an important metric, blah, 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 core PCE, blah, whatever. But I do think that if we print higher, the market might not love that reaction. If we print lower, but the Fed comes in slightly, firm and hawkish, the market might not like that reaction either. So this is why I expect Wednesday to be a pretty wild day. I'd like to personally be positioned for it prior to Wednesday. So something I might look at is maybe an afternoon position on Tuesday and just look and see what the market can do. Like pre-market, maybe there's a decent reaction on CPI Wednesday. But if it expects to be 3.4 and prints 3.4, it's kind of a muted reaction. Then it's all about the Fed. If we have a big hit where it's 3.5, 3.6, that's not good. We'll see how the market digests that. Or if it's a big, improvement, 3.2, 3.1, I don't know, right? I mean, we're grasping at straws and blindly throwing at the dartboard here. We have opening bell right now. We open slightly lower. But anyway, point is, CPI and the combination of FOMC CPI just for Wednesday, I expect there to be some good volatility and some follow through for the rest of the week. On top of that, we also have from Wednesday's FOMC, we have the old PPI for the US as well on Thursday and Bank of Japan on Thursday to Friday. So, Forex traders, buckle up as well. Dollar index, JPY. Let's see what happens. We just had 2 rate cuts last week that we've been talking about, this monetary policy divergence. The ECB cut rates, the Bank of Canada cut rates. This is what I expected to see. So now if we go back to the charts here, let's talk about this little bell curve. Okay, so this is where rates are at. So if this is our cash rates, we're still sitting at, here's 0. Okay, so we have the Bank of Japan still down here. We have had the Fed. So we have the Fed is up here. Let me type this out. So we have the Fed. So USD, right? Still up at 5.25%, 5.5%. We still have the Bank of England, and then just recently we saw a shift lower. So the ECB cut rates and the BOC cut rates. We saw the Swiss National Bank cut rates, and who's still holding steady along with the BOE and Fed would be your RBNZ and your RBA. So Australia, New Zealand. So these have all kind of stayed steady. So Bank of England, I would include that with there as well. RBNZ is at the same rate as the Fed. RBA is a little bit softer at 4.35. The Bank of England's at 5, I believe, or 5.25. And ECB cut to 4.25. BOC cut down to 4.75. Swiss National Bank cut to 1.5. Bank of Japan at 0 to 0.1. So it's still just off of negative interest rates for the first time in a decade. But the first, major cut, and this is what we've talked about, monetary policy divergence. All these banks were pausing, trying to hold off until it maybe was in unison or in, kind of a synchronized cutting cycle that if the Fed cut, let's say in March or in June, we probably would have seen other central banks cut as well. The Fed didn't cut, right? The Fed hasn't cut yet. Possibly September, November, December. We don't know when it's going to be. It's going to be here at some point. Maybe, maybe not, right? It honestly, yes, it matters, but the market's already pricing it in. Or if the market hasn't priced it in, it will certainly pivot to price it in when it catches wind that this is when it's going to happen. And that could be up or down. I truly don't know, right? What I do know is I still have a plan for whether the market's going to be higher by the end of the year or lower by the end of the year. From this point, I still want to make money. And so if monetary policy is going to be a contributor to that for a bullish move or a bearish move, okay, fine. But to me, I mean, what's happening in the background, at least going into the election, is copious amounts of fiscal stimulus. Again, I don't think people have realized how much that has played into these higher movements in the stock market. Lots and lots of government spending, lots and lots of fiscal stimulus, not coming from the Fed. The Fed has been tightening the balance sheet. The Fed has been, going to auction for short-term durations to finance and then get that out of the way and hopefully be able to cut and see things get a little bit more affordable with the debt bubble that we seem to be in. But, that could be a can that's kicked way down the road. And there's all sorts of creative, accounting that goes into that when it comes to these central banks. So, monetary policy divergence, we're starting to see that there's shifts happening. So does that mean that other central banks are on tap to cut? Possibly. Could the Swiss cut again? Maybe. Will the ECB do a tester cut with the BOC and then just pause for the rest of the year? Maybe. Will the BOC be next to cut? Right? Is the Fed going to be a little more transparent on when they cut? Maybe. RBNZ, RBA? I don't know. I mean, to me, they haven't really talked about cutting, so I think we have to wait and see. And that's kind of where a lot of this stems. So, all right, we're trading at 532. I believe I'm going to go out. I'm going to look at this trade right now. So with a $12 expected move for a week and, implied volatility is around 14, I'm going to go out to, let me see what this cost me. If I went out to the 28th, it's going to be a little bit pricier, but if I went to the 28th and we have some direction, I should be able to buy myself enough time and value that I can see something, hopefully pay us. So let me see what the SPY 26. Let's go June 28th. That's a quarterly expiration as well. Okay. So if I did something $1 apart, that's not too bad. I would pay $10 for this trade, and I would hope that from this point, we can at least have a $12 move one way or the other in the next couple of weeks. I'm going to take this trade. It's going to be a little bit more expensive. This might turn out to be a $10 debit that by the end of this week is paying $12, $13. If I go, let's say 532, I'm going to go up like 15. So this is an applied volatility move of around, $11 or so, which means I'm paying a little bit less for it, which is fine. But if let's see, this is at 532.80. That's close to 533. So this is going to be a trade that I'm placing for a June 20th. If I've got any equities on demand students out there watching this, this is a trade I'm going to take. I'll post this in the trading room, so we'll talk about it more in class at 11 o'clock. But I'm going to take this trade. Now, I'm certainly going to sell against this out for the couple of weeks. Now, let's go to like 549. Okay, so that'd be a $15 upside. I can sell that for 50 cents. And if I did a $15 downside, that put me at 517. Okay, so I can turn what I believe in the next couple of weeks could be a $10, $11, $12 move. I can pay, $8 and change for that. So to me, probability of profit, I'm looking at, let's see, I'd like to increase my max profit a little bit more if I could. Could I go from 32? Let's go $17 here. And then 34 to 51. I'll go to 50. So I'll do this. I'm gonna make this about a 1-to-1 as far as max profit goes. But I think the reality is, for my risk right here, for my max risk to be about $8.55, I believe that my max profit of 840 probably. I probably won't hold the trade all the way to expiration to get my max profit. What I'll probably do in this place is I'm going to look for like a 25% to 35% take profit. So if this turns into a, $10 to $11 credit, I'm probably just going to take the profit on it. So I'm going to take this trade. Let me see what this ties up for buying power if I do 2 contracts. So I'm going to go 534, 532 on my long options. I'm buying a call at 534, buying a 532 put, and then I'm going to sell. This is $16 to the upside, and I'm going to sell a $17 to the downside. Okay. So yes, there's risk on the trade, but do I think I can turn this from 856 into, 1050, 1150, or $12 over the next 3 weeks? If we can have direction that covers 10, 11, $12 of movement, this has plenty of space to give me profit. So I'm going to take this trade. This is going to be for everybody. So placing the trade here, edit. Let me see what I can edit this for. So 855, hopefully I can get filled for. And buying power is going to be about $1,700. So I'll put everybody in at 860. So 860 should feel a little bit less than that. I'm going to go 859. Fill to 858. All right, so let me do similar. Get this trade in here. So 9732. Placing similar 8051. Similar 911. Can everybody hear all the chirping and beeping going on? I don't think you can, but if you can, sorry, I know that's just the trading platform. 151. And 9072. All right, so that trade is in. So let's go trade tracker. That's a master account trade. Okay, so I'm doing the 534 by 550, and I'm doing the 532 by 517 or 515. So $16 and $17 is costing me $8.59 debit. Protect, let's say 10.59 or better. Okay, so that trade is in. And all I'm doing on this trade is the following. So 534 by 550 and a 532 by 57 or 515, 8.59 debit. So it's basically a vol play for a June 28th. And all I need is from current price at 532, we're either going up to, let's say 542, that's a $10 move, or we go from 532 down to 522 or lower. Anything beyond those numbers I just mentioned, if we go up above 542, nice profit. We go below 522, nice profit, right? Ideally, I'd like to turn this into an 859 debit. If I can close it for 1350, 1450, my max profit is going to be around $16 or $17. That's my max profit. So if I can capture most of that profit, I'm pretty happy with that overall. Okay. All right. All right. So that's the SPY. And again, I could do this and say, oh, I'm going to do this on the Qs and do this on the IWM. I'm really not. I'm just going to trade the S&P, do a couple of contracts, let this be a broad market play. The next one I'm going to look at is NVIDIA. We're trading here at 120. Let me see what type of position I can. I mean, I don't mind taking shares of NVIDIA. If we drop, for example, and this also makes my puts a little bit cheaper. If I want to do a put on NVIDIA, which might be like just a waste of money, so I'm probably not going to do that. I could sit here and be bold and say I'm gonna short Nvidia right now. It's like it's cheap to short it because we just had a 10-for-1 split, so the option prices are way different. But I want to look at the option chain, number one, and I'd rather see look, if we came down for a 17 to 20% correction, are you interested in buying the dip? Because I am, right? So because it's now a 10-for-1 split, if I go to Nvidia with a higher IV rank at 37. Let's say I go out about 40, that we have a June 20 or July 26 expiration for 46 days. I might look at a ratio spread. And what I'm going to do here is find a delta that I'm happy with. Could I own NVIDIA at like $100? Sure, it'd be an 11 delta. Okay. So if I want to say I'm going to own the shares at $100 and I'm going to do two contracts, and then against that, I'm going to buy the 105 for a one contract. Let me see if I can turn this into a credit. So I get 33 cents for that trade. Obviously, I'm not excited about the 33 cents. I'm more excited about the fact that if we did go down to tap 100 or lower, I can get $500 in the process to lower my cost basis. So I could get $5 of profit and another 33 cents to go with that. And then my break even turns into, $94.70. That'd be my break even on owning NVIDIA. Now, I'd like to, like right there, 50 cents. Now I get $400 and change. That's not too bad for ratio spread. The problem with this one as a ratio spread is, as you can see here, it is a lot of buying power if you are willing to own the shares. Now, if I wanted more credit, let me clear this out. If I want to say, all right, let me start with a trade that I like. So I'll start at $100 again and say I'm willing to own NVIDIA at $100. I could get $1 just for a naked put, right? If I get $1 for a naked put, I can own the shares at $99. So you can see why the ratio spread to me is a little bit better, because if I'm going to take on the shares, if I'm going to tie up $9,900 in buying power, then I might as well, collect more credit, because if I'm right on a bear put spread, that's what a ratio spread is. It's a bear put spread, which means I'm bearish on NVIDIA up to a certain point to max out that profit. I'm still willing to take the shares and own NVIDIA, and I can do that for a pretty nice chunk. So naked put, a little bit more buying power. Now I can space this out and say, look, I'll still take the shares and maybe go out like $10. Let me see what this does. So I could grab 76 cents right here and tie up a tenth of that buying power. which to me is okay. Now let me find out. If I really wanted to own Nvidia, that's around. I mean, if we came all the way back to like $80 or $75, that's kind of a no-brainer for me as far as would I love to own it there? Yes. If we turned around at the money, let me see what I could do to repair the stock. So if I bought it at 100, or let me do this. If I did a 95 by 80, so I could get 84 cents of credit. That can't be right. Oh, I need to buy this one there. So I could do about 50 cents or 60 cents of credit, take ownership at 95, repair the stock pretty easily if I went out to, let's do like a 30-day covered call right now. If I did a 30-day, I mean, this is crazy, right? If I did a 30-day at the money, I'm going to get $5 or $6 to repair my stock. I could make Nvidia very inexpensive with a couple of covered calls. So I think this is a pretty good trade. July 26th, if I sell the 95 and then I buy the 80, that makes this, so all my cash accounts, my IRA accounts, I could afford this because it's only going to take up about $1,400 in buying power, but I'm also willing to own the shares. So even if I have, let's say $9,400 to own the shares, do I have $9,400? Yes, 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 yes. Like everybody in my portfolio here could own Nvidia. And for a $250,000 to $300,000 account, if I tie up $9,000 or $10,000 cash, let's see what that is. Roughly, everyone's account's like $250. So if I did, let's go $9,400 would be my cash basis, $250K account. It's about a 3.7% position on Nvidia. I'm okay with that exposure. I could certainly cover it. So anyway, I'm going to take the trade. I'm going to keep the buying power low for everybody, so I don't need to do the ratio spread. Although it would be lovely to take, a cost basis around the same price, but this way I'm tying up way less buying power, still willing to own the shares, and still grab 50 cents credit. So I'm going to do this for everybody here as well. So this is a 95 by 80. This is a bull put spread, but a very wide open bull put spread. Okay. So because I'm going $15 wide, I'm not collecting the amount of premium that I'd like to, but I'm also trading at like a 7 delta. So I shouldn't expect to make a ton of premium on this. If I wanted to make more premium, I've got to go 15, 20, 25 delta. I'm not doing that, right? I want to take ownership where I'm willing to say, I'll own Nvidia here and repair it and look for more upside. Because let's say that I'm right and I can actually get some assignment on Nvidia and I can exercise my options here, take the assignment at $94 or $94.50. And then if I say, okay, where I own it at $94.50, which is right in here, okay, and it goes down to, $80. Well, on a couple of covered calls, if I can repair it for $4, $5, $6 out of a 30-day cycle, all that means is my cost basis goes from 94 down to 80, 88, and then from 88 down to 82. And if I held onto the stock and it goes up to the top again at 125, I could turn this for a $3,000 to $4,000 profit with 100 shares. Again, it's only making 1%, 2%, but if it moves the whole portfolio, it's just a trade. Okay. All right. So I'm going to try to get 95 by 80. I'm going to see if I can get 55 cents for this, and this will get everyone's little piece of the action here. So filled at 54 cents. 9732. Filled at 54 cents. 8051. 911. Okay, just going to fill up these orders. And 151. 9072. There we go. All right, so that trade is in as well. Okay, let me check one thing really quickly. And I do want to let everybody know that I will take a small break prior to my 10 o'clock session. If you'd like to join me, I'm going to join the A1 trading team, and that'll be at 10 o'clock. So I'm just going to go a couple more minutes here for the Pulver report for my session on the YouTube channel, youtube.com/Chris Pulver. And we'll come back at 10 o'clock. I'll just do another stream. I dual stream. So when I join the A1 trading team, they push on their channel. I push on mine. So however you want to find us out there, I stream on Twitter, on Facebook, on LinkedIn, on YouTube. So I'm hoping that it's pretty easy to find me out there. If you haven't subscribed to the channel, please do so. You know, I'm here to help. I'm here to trade. If you have some questions or anything you want to review, let me know. I played a lot of catch up this weekend, listening to some, the typical financial podcasts and the reading to get caught up and get ready to trade this week. But I like what I'm in thus far. Taking a chance on the SPY here for the next couple of weeks. I do expect there to be enough volatility to see a 10, 11, $12 move one way or the other. And obviously I want to capitalize on that in the near term. And then the rest of this, just watching the portfolio and just managing. So, gold's been down, silver's been down. I wouldn't mind putting on a couple of futures trades on some, crypto, but I'm just going to hold off and see how the dust settles with the Fed. I mean, it could be look, technically speaking, it could be a very volatile week. We could see a downturn. We could see what is needed on the technicals with overbought conditions, right? Overbought conditions with divergence typically is a high probability trade that just does that. It just corrects. Now, it doesn't have to necessarily take out the lows. We could have this dip back down here and then the market rips back up again and we just keep, grinding higher for the rest of the year until we get the election. And again, I'm just throwing this out there. This market might not give a crap about anything, right? I mean, this could look like it's so close to tipping over, and it could just do this and this and this and this and this and this and this. And then we have the election and it's volatile and it blows off the top. And then in 2025, I'm a freaking bear. If this is what happens for the rest of the year and it just grinds and grinds and grinds higher and it's led by 5 stocks and the broader market is underperforming, but it still goes higher, right? And that's what's funny is like you read about these perma bear cases and these. I don't care about any of that. I'm just watching to see. I mean, this market can keep melting up and we could blow off the top and we could capitulate before we have, the reset, before we have the reality check, just like we had in 2022. So again, I will continue to position accordingly over these kind of 30 to 45 to 60 day cycles. For me, I've been concentrating my portfolio more and more and more. I just I like what I'm buying. I have a slight bullish tilt. I'm playing the positive drift with historical significance. So anyway, that's my plan for the rest of the year. It's like I don't know what else will derail the market, but certainly the Fed this week. If we have a higher print for CPI Wednesday and the Fed talks it down, saying, "Look, we don't want to cut. we don't think the data supports a cut yet." And all of a sudden, everything on the watch tool changes, and all of a sudden, it's kicked out to December, kicked out to 2025. If that happens, we should see the market, pull back a decent amount. It could be led by Nvidia. It could be led by Mag 7. It could be led by a lot of things. It could just be a broad market sell-off. To capture that, I'm going to trade the SPY. All right. So that's where I'm at right now. So SPY, Nvidia, cost-effective way to trade Nvidia. I want to own the stock. I mean, if I could own Nvidia at a 20% discount, I do it. The premiums to sell Nvidia, as far as trading like a covered call is ridiculous. I mean, for example, I just flipped, and I think I'm going to do this on CVS as well. I just flipped. CVS is trading at 61.26. I think these expirations are coming up pretty quickly. Let me check this. CVS right here. So CVS, as long as we stay above $60, I'm going to flip this stock for like $4 a share. I don't have a lot here. I have 100 shares. So 55.35 I bought. Take away the 70-cent covered call. I own it at 54.65. Get it called away at $60. I turn this for a $535 profit over about 30 days of holding it. So, I tie up around $5,500 or less with a margin account, but let's say a cash account. I tie up $5,500. I make over $500 in the trade. It's a quick, 10% on that position, or roughly a like a fraction of 1% move. But it was easy to repair. Chewy, a little bit more profit on Chewy. Okay, Chewy, I had a break even around $14. I turned around and flipped it at $20, got it called away for $500 a share. So Chewy's trading at 22. I still own shares myself. I'm looking to get it up here towards 25. But I own Chewy and quickly lower the cost basis down below $14. Got it called away at 20. Flipped it for over $6 a share on 500 shares. It should have been, for everyone's account, it should have been close to like $2,000 of profit when it was all said and done. So there are some stocks that I have some ownership. I'm not looking for long term. I'm looking for if I can flip this in 30 to 45 days, get $1, $2, $3, $5 a share, just flip it, find another one. But meanwhile, I trade heavy on the indexes, trade both directions. I position for what I want. So if I'm willing to own things, I want to own it where I want to own it. I'm not just going to jump in and say I'm going to dollar cost average. No, I'm not doing that. I'll just trade options. Okay, I'm gonna let you go. We got a 5-minute break. Just come back into the stream. I'll be right back on my channel, youtube.com/Chris Pulver, in about 5 minutes, and we'll kick things off with a little combo with A1 Trading and myself, and continue on for another segment at 10, 11 o'clock. We'll do an equities on demand trading room. We might start at like 11:05, but traders are used to that if I run a little bit long with the A1 session. So, all right, thanks for being with me today. It's nice to be back. It's nice to be back. I mean, honestly, I know it feels like I'm going to be catching up all week, but I'm really not. I mean, I followed things closely last week. It just didn't require me to do a lot of trading, which I'm totally happy with. And off we go. This is actually a bit more of an exciting week, in my opinion, anyway, with the combo of CPI and the Fed on Wednesday, and that's where all the fireworks are going to be sitting. So let's trade and have some fun. All right. Thanks, everybody. I'll see you in a few minutes. Bye.